Augusta here from The New Face of Finance. Welcome to the 2021 Quarter 1 Business Update. So the current Chancellor of the United Kingdom, Rishi Sunak, has announced that the stamp duty holiday will be extended from the 31st of March 2021 until June. Now, what is stamp duty? Stamp duty is a tax levied on certain assets when they are purchased or transferred from one legal entity to another. The stamp duty that is monopolizing the headlines refers to stamp duty land tax. So you've got stamp duty land tax, you've got stamp duty reserve tax. Stamp duty reserve tax would be the tax that you pay on like the transfer of shares within a company, etc. Stamp duty land tax is the tax that you pay when you transfer land or property. So if you go and buy a house, subject to certain conditions, you'd have to pay stamp duty on that. How does that particularly impact you? If you are a first-time buyer and you are planning to purchase a property for £500,000 or less, you are exempt from any stamp duty. Now, this was different before the stamp duty holiday. This was on assets, houses and flats less than £300,000. So on average, people are saving about £7,000 on transactions. It also applies to people who own more than one asset. And so essentially you would receive a discount. It's not like you wouldn't pay any stamp duty, but you would receive a discount of thousands and thousands of pounds. How does that relate to me and our current situation? Well, we are presently in the process of renovating the house that I grew up in, my mum's residential home. We've received planning permission. We're turning it into 4 flats. And for long-term tax purposes, we would like to transfer that asset into a limited company. Now, if we manage to transfer the asset before the stamp duty holiday ends, we save about £35,000 to £40,000 in stamp duty. And so it's really important that we try and do it before the stamp duty holiday ends. It seems like that's not going to be a problem. It was a concern previously, but that seems like it's not going to be a problem. There are other challenges which I shall bring up later in this video. So we had an amazing year last year with our serviced accommodation business. Our houses, instead of having tenants, we let them out on a short-term basis, so people can come along and stay for a few days at a time, for a few months at a time. But it's not the house that you come and you settle in and drill things into the walls and get your pets and your family around. It's not that at all. The way that we see it, very much a stopover property. So some of our previous guests have been students who perhaps go to Canterbury University and have gotten placements in the Margate Hospital, the Queen Elizabeth, Queen Mary Hospital, and they need somewhere to come for a few months to do their placements. We're perfect for that kind of thing. Or you've got locum nurses who are working in the area. Again, our properties have been very good for those kinds of people. And then in the summer, you've got your holiday makers who just want to spend a few days on a coast and have picked Margate or Ramsgate. And again, we are very good for those individuals and families. What we are not very good for is for people who come along and want to stay a very long time and put roots in. We're just not that. In any case, last year we had a very successful year with the serviced accommodation business, despite COVID. All the houses were up and running. They were all in good condition. There was a lot of staycationing, and so we did some very good numbers. This year, January and February have been very difficult. The numbers have been much lower, but that's to be expected. And as we go into the spring, I expect that things will start to pick up. especially as more and more people are vaccinated, especially as more and more people will need a holiday. January and February is always quite expensive. It's right after Christmas. It's always cold and miserable. And so I always get quite excited around this time of year as we go into spring. It's also amazing because we have won awards from booking.com. I have to congratulate Nick for this. Left to me, it might not have happened, but he's very, very good at maintaining the reviews. So I'm very pleased with that. And now what it means is that we have 2 award-winning businesses. Mortgage business continues. One of the things I'll take some time to talk about today is maximizing on investment properties the income from your properties. Now you can maximize the income from your properties in a number of ways, but probably the 2 main ways to do this is either to run it as a short let or a service accommodation business, which we do. That has its risks. And one of the risks is that you're potentially going to have void periods where people aren't booking as much, and therefore you're going to have cash in the bank to be able to make up for those periods. But on the plus side, what it does mean is that in the summers, you're able to make a lot more income than you would do if the property was just on a standard let. The second way that you can maximize investment properties is by using it as a house of multiple occupancy, or a HMO. Now, I have some clients at the moment, and we are either purchasing or refinancing HMOs, or purchasing buy-to-lets to then convert into HMOs and then refinance those securities once they're in a good condition. However, I have a family that have come to me, and we went back and forth for a few months about the best way of transferring the asset from the parents' names into the child's names, or some of the children's names. I thought the best way to do this was through a limited company, but they couldn't find a way to make this work, so they decided to transfer it into 2 of the daughters' names. We then put it with a high street lender because the credit was there and the income was there to support it. And one thing I always say is it doesn't matter how amazing a broker you are. If there is inaccuracies with the property, and if a valuer goes out there and notices that there are issues with the property, you will not get that mortgage. So it's really important that you are open and honest and clear with your mortgage advisor about the state and condition of your property. And one thing that really eat me was that the family did not inform me that the property was a HMO, despite me asking. And so when the valuation was returned, it transpired that the property was being used as a HMO, and therefore this high street lender could not lend. Now, the issue with that is we've got to start the application process again, which, look, it's not the end of the world, but it's always a challenge when you feel like your clients aren't being that honest with you. I contacted them and I said, look, the property is an unlicensed HMO and therefore the lender can't lend. And their rebuttal was, it doesn't need to be licensed. I think they missed the point. The point wasn't that it was unlicensed. The point was that it was a HMO, and that lender just does not lend to HMOs. So over the next week, I will be having clear discussions, making sure there's no more information that's being hidden from me, and recommending so that they get to the solution that they are after. Now, if you are going to go down the service accommodation or HMO route, I think the important thing to realise is that you can't expect to get the lowest rates in the market. You are going to be maximising the income, and therefore there's a higher risk for the lender. With the service accommodation, there's a risk that you will have more rental voids, and therefore there's a higher risk that you'll miss mortgage payments. And with HMO mortgages, you have much more people in the property. Therefore, if the lender needs to repossess, it's much harder because there are more tenants. And also you have risks, the risk of a fire, for example, is higher because there are separate households. So if I'm in room 2 and a fire starts, I'm going to get out. I might shout, hey, everybody leave, but it's not my child, it's not my mum, it's not my granddad. I don't have a vested interest in making sure that everyone is out the house. And therefore there is just a general higher risk for lenders when they're lending on these properties that are going to offer you higher yields. As such, they're going to charge higher rates. So what you can't expect to do is to maximize your investment properties through using these strategies and then expect to pay a low rate as if you were just having a standard tenant in that property. There will be a trade-off. As previously mentioned, we are in the process of starting another development in London. I'm going to be making videos to take you along this development, and as we progress, show you some of the challenges that we are encountering. But over the last few weeks and months, there have been a number of challenges even before the development starts. One of these main challenges has been raising finance. Now, I think I'm a particularly great broker. I specialize in very complex creative problems. And I've been quite fortunate that I can hone a lot of these skills through doing projects and investments for myself and my family. However, one of the biggest challenges that we have is with raising finance. And that is because despite the fact that we own the land, we own the asset, amazing, we haven't got to find the cash to actually physically buy the asset. There is quite a lot of debt on the security, and that debt has been amassed and accrued through various projects and then us transferring the debt onto the asset. So what a lender usually looks to do when it comes to development finance is lend you no more than, say, 65% loan to value of the gross development value. So 65% loan to GDV. Now, the gross development value is the aggregate value of each unit once the property reaches its highest standard. So if, for example, when the property is done up, you're going to have 5 flats and each flat is going to be worth £200,000, then the gross development value, or the GDV, is £1 million. So like I say, a lender would look to lend you 65% of your GDV maximum. However, this breaks down into even more detail. Now, within that 65% loan to GDV, a lot of the time they would look to deduct an arrangement fee, and also there'll be monthly interest attributed to the loan. Now, you can choose to service this interest, but your focus really during a development project should be to get the project done as quickly as possible. So the last thing you need is the stress of running around town thinking, oh my gosh, how am I going to find the money to pay this interest on a monthly basis? It's not like you've got tenants in there and you can raise these amounts. And also with quite large scale development projects, these are quite hefty amounts. So say, for example, you have raised a loan of £500,000. 1% of that £500,000 is £5,000. So every month you're looking for £5,000 to service the loan. So to avoid this stress and for you to focus solely on developing this asset as quickly and proficiently as possible, lenders will allow you to roll up or retain that interest. So from that 65% loan to GDV, you would deduct the arrangement fee, typically 2%, and also roll up the interest over the period that you will be using the loan for. Now, I typically roll up loans for a 12-month period, 12 months allowing for the person, myself, my client, to complete the works. And then once they've completed the works, then to refinance out of the loan. So you have to understand how long you expect your build to be. You would then build in some contingencies. For example, if you think it's going to take you 4 months to build out the units, then you would probably add another 2 to 3 months on the end of that. Let's call that 6 to 7 months. Then you would look to refinance. And yes, it might take you 4 weeks, but it could also take you 3 months because a number of challenges could come about. And therefore, you had another 2 or 3 months. And therefore, 9 months, let's say. And you could probably be out the project in 9 months. Having said that, if that is the scenario, it still makes sense for you to roll up the interest to 12 months. The reason being is if you do manage to get out within 8 or 9 months, fantastic. The lender will recalculate and rebate any unused interest. However, for any reason, if you do extend over that 9-month period, you have that 3-month buffer at the end. And then you don't enter into default. And typically when you enter into default, the interest rate will usually double or triple depending on the lender's guidelines. So it's always best to ask for more time than you need and then work to get it done as quickly as possible. The next consideration would be the cost of works, which is something that you should know before you raise any finance. Now, a lender would look to deduct the cost of works because they would want to fund 100% of the costs of work. So once they've deducted that, then the amount that is remaining is what would be given to you for the land purchase. Now, in this instance, like I say, we're not purchasing land, but there is some debt that we need to ensure is paid off so that the lender who's lending the money to us can take a first charge on the security. So once they have deducted the interest, the arrangement fee, the cost of works, the amount of money that we have is not sufficient to cover that security and therefore give the lender the first charge. The challenge was finding a lender who could provide enough finance to do this. As well as that, although we had received planning permission to move on with the works, there were some conditions that needed to be discharged to the local authority before the building work could start. There were maybe 30 conditions that were listed on the accepted planning document. These ranged from going out and getting an air quality ventilation report. This was particularly necessary because the property that we will be refurbing is on a busy main road where there's lots of traffic coming past, and therefore the residents of that area unfortunately are subject to a bad level of air quality, and therefore we had to think about that as part of the building project. The next thing to think about was the acoustics and the sound. Obviously, on each side you have neighbours, so you have to ensure that the sound is insulated on your neighbour's side, but also we have 4 flats, and therefore you need to ensure that there is adequate soundproofing between the floors, and therefore we had to go get a report to ensure that this would be done correctly. Being in the centre of London, the local authority also wanted it to make it clear to us as developers, but also to future tenants or buyers, that there would be no car parking provision because it was already a super congested place and parking was a major issue. As part of the design, we had to construct a space for bikes so that there were bike racks if people wanted to cycle, but there wasn't really an option to get a car or a permit for a car. The council also stipulated that they didn't really want any gas in the property and therefore wanted us to go and source a zero emission electric boiler in replacement of a gas boiler. And so as such, you also have to find an electrician who is adept with this new way of developing and therefore could provide us with the specifications that were required to meet these goals. I mentioned previously about the fact, especially on terrace properties, you have neighbours on either side, and therefore you would have to communicate with these neighbours and sign what is known as a party wall agreement. The agreement essentially stipulates that if there is any damage caused to either of the neighbours' walls because of the works that are being undertaken, then we would be liable for that damage and have to pay for any required repairs. Also, we have had to put together a schedule of works. This is essentially a breakdown of the works that will be required to bring the development into being, and also the timescale that will be required. This would have to be agreed with the builder alongside the costs per section, per milestone, and this will be presented to the lender for their approval. So you can see a lot of work goes into the initial stages before the building work even begins. As well as having a newborn baby, we've also had to contest with keeping our businesses up and running, and those are some of the issues, challenges, considerations that we've had over the first quarter of 2021. Thank you for watching. I hope that was useful. Do not forget to subscribe and hit the notification bell so you know when new videos are released. Join me for the next video.